bring your stops to break even at any stage ever. And that means you've got to be more proactive in the management of your stops. So the market just doesn't spike you out and you're like, damn it. You either decide to come out or you decide to leave the trade on. So either the trade's good enough to add into it and keep going, or the trade's not good enough, in which case you should be more aggressively bringing your stop into play a tick or two, maybe even away from the current price. So we can see that based on value, can't we? So for example, I took my oil trade out as soon as I saw the value getting lost there. So you can see what happened. I was able to get into the trade. I didn't move my stops to break even. I kept them miles away. When the market drops, I'm looking at a very big value drop to the downside. However, you can see what happened right there. I lost all the value lines. Because I lost all the value lines there, at that stage, you can say, right, I'm going to bring my stops into a very, very tight 1 or 2 ticks behind the current price. So if it develops back to the upside, then I'm still in it. I'm only giving away $20 to find out, right? I'm giving myself about a $20 window to give it a little bit of breathing space. I could give it $30, I could give it $50, but you start getting into a trailing stop then. This is not a trailing stop. This is a managed stop. So I'm deciding how aggressive to be, not the indicator, not the algorithm or anything like that. I'm deciding how aggressive to be. I'll make my decisions. So the market won't take me out. I'll take me out. Thank you very much. And that's exactly how it's played out, because obviously when I saw that developing there, I was able to then say to myself, you know what? I don't think it's got any further to go. I was then able to bring my stops into a very, very tight couple of ticks below the market. It goes up a little bit further and then stops me out for a very, very substantial profit on that little trade there. So I chose to get stopped out. So that's one solution to a break-even stop, is just don't use them. If you keep getting stopped out at break-even, stop using the break-even stop. And therefore, what are you going to be moving into? Now, why is a break-even stop good? Because it can obviously protect you from more losses. But if the intention would be to add back in again, if you think it's going to go lower, why would you even need a break-even stop? If you think it's going to go lower, you'd simply have taken your trade off anyway before your break-even stop. So if you think it's going to go higher, why would you want to get taken out? Because if the value is improving, you'd add it straight back in again. So why even have the break-even stop in the first place? Now, there's obviously some situations where break-even stops make sense. A phone call comes through, you're up 5 ticks, and you've lost the control of your screen. You're no longer focused on your screens. Stops at break-even. Worst case scenario, come out of your phone call and all of a sudden you're scratched. Or you still might be $1,000 up. RGLs, break-even stops, absolutely. In the overnight session, you get your trade on, you're making some great money, and you simply get your break-even stop in place, you go to your bed, and that's it. If you're waking up with $1,000, so be it. And again, there's always reasons why it sometimes makes sense to go for that break-even. However, if you're actually at your screens and you're managing an open position, maybe break-even is the problem. Just try not using it. Try not using it. There's nothing wrong with managing a stop. So the fact that it's a break-even is actually not really that important. Because if you think the price is going to go down against you, you take your trade off anyway. And if that's at break-even at +1 or +2 or +5 or -1 or -2, well, take her out. Take the trade out. If you think it's going against you, take it out and get ready to deal again. And then it's you that's deciding. At that stage, it's you that's deciding. So just don't use break-even stops. But it might not work for you. You might feel uncomfortable with it at first, but you've got a hard stop in place anyway. So manage your stops. It doesn't mean don't take the trade out aggressively, but what it does mean is as soon as you see the value changing, take the trade out aggressively. Subra, yeah, one of the things that we've kind of said for many years in the class is that you should start your trading by focusing on one single market. Absolutely, no doubt about it. Start your trading by focusing on one single market. Otherwise, you're not getting the necessary skills in that market, spending enough time to get to know the market intimately, the flow of the orders, the size of the liens, the size of the book, the way it works, the times of the day, the headlines, the news releases. You need to become a specialist if you're going to make money. There wasn't a pit that had the bond traders battling it out with the oil traders, battling it out with the S&P traders, battling it out with the gold traders. That pit didn't exist. There was a bond pit. There was a notes pit. There was a gold pit. There was an oil pit. They all traded and they all specialized in those markets. Even on the floor of the exchanges, the stock market, you've got traders, market makers that specialize in one particular sector or even one single share. They specialize in a single share. And if they specialize in a single share, we can start to recognize why that's the case, because they know how to trade it. They know how to price it properly. If you're trying to price oil, it's going to take a bit of time. It's going to take a bit of effort. If you're trying to price oil and equities and bonds all simultaneously, you're never going to have a chance to even trade the damn things, even if you've priced them properly. You need to focus on a single market to get started. It doesn't mean, the good thing about it is the skills are transferable. If I could make money on the floor of the bond pit, the same techniques are used when I move into the floor of the oil pit, right? Same technique, same idea, same basic flow of cash, the same idea that I would have to learn a few of the nuances, but it's still the same basic auction process. Different players, different sizes, different drivers, but at least the techniques that I've learned from the bonds can allow me to trade in the floor of the oil quite effectively. So you can cross over once you've got the basics nailed and once you're starting to make money. But remember Nick, when Nick used to come in and Nick was all over the place. Nick wanted to trade this and Nick wanted to trade that and Nick wanted to trade the next thing. And he was a very talented young lad. I think he was the youngest guy we had in the class at the time. We said, look, Nick, stop trying to jump. Just stick with one bloody market for a month. Don't even if you hate it, stick with it for a month and try and learn that one market. And that was it. And that was it. So we started to see the market started to become something that he knew about. He started to get to know the levels. He started to get to know the actors. He started to read up about it as well. You started to get a little bit more knowledge about it. And all of a sudden, by sticking to one market, he started to then look at the idea of becoming a professional trader. I don't ultimately know what's happened to Nick. He's sometimes popped in, but he hasn't been in for a long time. I hope he's been able to make the transition into institutional trading, but as I said, I haven't spoken or heard from him for a long time. So my wish is that, or my hope is that he's been able to make that transition into that institutional trade desk. He's still working for the firm. That's great news. That's absolutely superb news. I think he ended up trading agriculturals. I don't know if he, what ags he traded, but I think he ended up trading agriculturals was the last time we heard from him. Big offer on oil just now. I was hoping to get a little buy trade there, but there's a big offer on oil just now, so I can't take the deal. I thought it was going to start developing into a nice buy, but it's, as I said, a big offer stopped me getting the deal done. And again, that's that little crossover. So you can see that there was a little value starting to develop on these downticks here, but then we saw a big offer surging into this, and there's no way I could buy into it. It was simple as that. There was no way I could buy into the narrative. Still think there's a little bit more of a press here coming. That last move lower was brutal, wasn't it? That was a fast money move. That was very, very aggressive. But market makers starting to take a little bit of an interest in this price here at the 75, 74, 70s area. We'll get a little bit of profit out of that trade for sure. There was a little Voltic came in there at 72s, so that was my lean. So I took a buy at 73s, paid the spreads, took it up to 77s for 4 ticks, and I'm just seeing if I can hold on to it just now, to be honest. 74's traded. I'm watching the value, just as I mentioned to Catherine, I'm watching the value, and the value actually looks relatively good for this to keep it. So I'm not bringing my stops to break even on this one, Catherine, yet. I'm just watching the value to see if the value stays. Now the value's gone against me, so I'm getting more aggressively bringing my stops into break even at that stage. You see the change? But if the value starts evolving in my favor again, I'll pull away my stops again because I'm just going to buy more anyway. You know what I mean? So I'm going to buy more. So why would I want to get stopped out of the ones I've got? I might as well just buy more. So when I see the value improving, and again, you can see the value is a little bit bad for me. So I'm happy to get stopped out here. I'm happy to take currently 2 ticks profit on the trade. I've taken 2 ticks profit on the trade. The market maker's gone offered again. And I've taken 2 ticks on the trade. So that was good because the price has now dropped from 72s down to 67s. So I'd have lost 5 ticks on that trade if I didn't take the 2 tick profit. But the reason why I took the 2 tick profit wasn't because I get stopped out at break even. It's because the value looked pretty rubbish. And if the value then improves, which it did again on the down tick, all I did was I now bought back in at 71s this time. This time I bought back at 71s. It's now at 76. My stop is 15 ticks away. At the moment, my stop is 15 ticks away because I still see I've got a bit of value in this. Okay, so I've got value. If I want to bring my stops, I can always just whack in a quick order to get rid of the trade very aggressively. The market maker's a little bit against me. So I'm very mindful of the fact that the market maker is against me. If the market maker wants to play it downside, I'll take the trade out at break even or a break even +1 or even a break even -1 if I want to. But I'm constantly watching to see if I can get any value in this. This still looks like it's going to be going again to the downside. So I'm taking that trade out at 71s and I'm scratching another trade. So I'm getting ready to go again into the deal, right? I'm getting ready to go again. And if I see it turning again, I've taken a 2 tick winner and a scratch. And if I can get another buy trade in, I'll take the buy trade because I've got macro value, right? There's the macro value there. I've got enormous macro value to be long, right? So there's the buy trade there. I've got in it, I've got in it, and I've got in it, and I've got in it. I paid across the spread because I'd taken my trade out at 71s. I crossed the spread there at 74s, and it's just traded at 86s. Another 10 tick winner. I'm going to take some profits, and I'm going to take some stops to break even. That's a good trade. That's a good trade. So we've got all this macro value to be buying oil from, massive amounts of macro value to buy oil. But the market maker's always just been against us on pretty much every trade, and we've had to just wait for the market maker to start finding a little bid behind it to allow me to buy back in. That was another profitable trade. Another profitable trade, another few $100s added to the big old balance today. S&P's done well off the handle. I mean, we talked about the handle this morning. We actually gave a big shout out for the handle. We said that the big challenge will be whether they decide to buy the handle break or sell it. Well, we got the answer relatively quickly, didn't we? So we had a chat to everybody about the market makers and how they were going to deal. And we said if they buy the handle, that's a good sign. Well, this is how the market developed. We had the sell coming in off of that level. We came into this level. We set up a level 2. We set up a level 2. We came into the handle just there. They decided to buy the handle immediately, and we've obviously had a brilliant little rotation off the break of the handle itself. And you can see we've broken structure there beautifully. We're coming back into that beautiful maximum gain level. They've got a box level just above them to try and work into on the SPY to get a massive profit. You can see they're not far off it now. They've only got another $1 to go and they're back into the maximum profit box. And that's obviously where they're trying to take the price to.